So welcome back, all you savvy real estate investors. And today I'm super excited because we are talking about a topic that I love. This is where I earn my money. In part 7 of our tax entity structuring series, we are talking about utilizing your passive losses to offset your active income. So let's take you back to a simpler time. Ronnie Reagan was in the White House, Steve Jobs helped found Pixar, and a space shuttle exploded, devastating the nation. The year was 1986, and it was a great time to be a real estate investor and take advantage of the tax breaks available. You see, at this time, there was no such thing as a real estate professional status, reps. If you had losses from real estate investments, you could use those to offset any income you wanted. These passive losses could offset W-2 income. They could offset your business income. They could offset your retirement distributions. You could use them however you wanted to. But then came the tax reform of 1986. And this tax reform took the highest tax rate from 50% down to 28%. But what it also did was made it more difficult to take your passive investment losses from real estate and use those to offset your active income, because it created what's known as real estate professional status. Let's dive deeper into what this looks like in the current 2024 and going into 2025 environment. Build out a T diagram for me, right? And on one side of that T diagram, you've got your active income. The money that you sweat to earn or someone sweat to earn for you. This is your W-2 income. This is your business income. This is your retirement distributions. That's the money that you're gonna earn. You're gonna make money. Use that cash flow to live your life. Use that cash flow to invest in assets which are going to make you more money down the road. And on the other side of the diagram, you've got your passive investments. You've got your real estate. You've got your private equity that you've invested in and your other passive income generators that you wanted to invest into. In the middle of this T diagram, there's a firm line. And they are making it very difficult to take these passive losses that you have over here and to offset your active income. Or if you have active losses, they're not gonna let you take that active income and move it over here and match it up to your passive losses. So if you earn active income, and you have active losses, you can offset the two. The active losses will offset your active income. If you get down to 0, it'll carry forward as a net operating loss. At the same time, if you have passive losses, those can be used to offset your passive income. But most times those cannot be used to come over and offset your active income. So those passive losses in excess of your passive income, those carry forward. They're called PALs, passive activity losses. And if you don't know if you've had them, go look at your tax return, your 1040 personal tax return, and see if there's a form 8582. This is the passive active loss carry forward schedule. And it will show you if you've had losses in prior years from passive investments that you were not able to take. Those carry forward and you can use them in a future year to offset passive income. Or you'll be able to use them once you sell that property that they were associated with. So now in this post-1986 era, we've got 3 categories of real estate investors. There's passive, active, and reps. So let's break down what each is. A passive investor is someone who's investing into real estate without putting any work in. If I give you $50,000 to go invest and then you pay me back, I'm a passive investor. And what the rules say is that if someone's a passive investor and they have passive losses from their investments, they can only use that to offset their passive income. They can never use that to offset their active income. So move over to the next category, which is active investing. And this is what a lot of investors are. This is if you do any material work within the real estate investment that you go into. A lot of people are active investors, right? If I invest that $50,000 with you and I go paint, I am now probably an active investor into that investment. So what the rules say for active investors is, hey, if you have passive losses up to $25,000 in a year, you can take that $25,000. First, you can offset your passive income, and then you can move the rest of it over to active income. But after $25,000, nothing else can be done. You can just carry that forward to use in a future year. The problem with this approach comes for high earners. So what happens is once you make $100,000 of taxable income, they start to eliminate your ability to do this. So for every $2 above $100,000 of taxable income that you earn, they eliminate $1 of that $25,000 pool from what you can take. Meaning by the time you hit $150,000 of taxable income, you cannot take any of your passive losses to offset your active income. The entire $25,000 is gone. You just have to carry it forward to a future year to offset passive income in a future year. So let's move over to the last classification, which is real estate professional status, commonly referred to as reps. If you meet reps, whatever losses come from your real estate investments or other passive investments can be used to offset all your passive income, and they can be used to offset any and all of your active income. This is the reason to meet reps or to want to meet reps. If you don't have any passive losses, then it likely doesn't matter if you meet reps. Now, the next thing to know here about reps is that if one spouse meets reps, both spouses meet it. So if the wife is a W-2 employee and the husband is a real estate investor full-time who meets reps, and he has losses from his real estate investments and she has a W-2 earnings, his losses can offset her W-2 earnings and help get her taxes that she paid back. So how do you meet rep status? Well, first you have to materially participate in the real estate. And if you meet the next rule, then you probably met that one, because the next rule is one of two important rules that you have to meet, and they can be pretty tough to meet. The first one, you have to work at least 750 hours in real estate. We'll get into in another video what those qualified real estate activities are, but for now, just know that you have to work 750 hours and they can't be related to your W-2 work. And the second rule, which eliminates a lot of people from this status, is that real estate has to be what you do with over 50% of your serviceable time. What that means is essentially you cannot have a full-time W-2 job and be a real estate professional. Because if you're a full-time W-2 employee, you're working 2,080 hours in your full-time W-2 job. You would have to convince the IRS that you're working 2,081 hours in real estate, and we can review some tax court cases in future videos, but in general, even if you did, they're not going to believe you. Those are the rules that it takes to meet real estate professional status. It doesn't matter if you have a license, it doesn't matter what else you want to say, if you're a qualified realtor, anything like that. All they care about is, did you meet 750 hours? Is it what you did with over half your serviceable time? And did you materially participate? If you meet those rules, you will qualify as a real estate professional. If your spouse meets those rules, they will qualify. So a quick recap of how you put this together, in which you get passive losses, you create, accelerate them, and then you use those to offset your active income. First step, have active income, your W-2 earnings, your active real estate ventures, your other businesses that you're running. Get some active income, use that to fund your lifestyle and to invest in these passive investments. Next step, once you've got those earnings set and structures in place so that your business is running, ensure that you're maximizing deductions, minimizing income, properly timing and shifting these items so that you're paying the least tax on that active income as possible, and ensure that your entity structuring is set up effectively there. So if it's time to go S Corp or time to go C Corp, ensure you've got that in place. From there, you're going to take your earnings from this active income and you're going to invest into real estate, into buy and holds, into long terms and short terms. Once you've invested into those real estate passive activities, those buy and holds, you're going to create, increase, and accelerate losses on that side of the table. So now you've got large losses over here, you've got taxable income over here on the active side. And from there, you're going to ensure that in that year, one of the spouses meets reps. One of the spouses works 750 hours, and it's what they do over half their time. They don't have a full-time W-2 job. You're now in the perfect position. You can take those passive real estate losses that you work so hard to create, accelerate, and increase, and you can offset the active income that you work so hard to earn and get your taxable income close to or even down to zero. A few last notes on this video. There are many other strategies you can use to do this, and we will get into those in future videos, but they're outside of the scope of this one here. So those are things such as the STR loophole. Those are things such as using PIGs, passive income generators, to create passive income that you can use your passive losses to offset. And lastly, a pretty complex topic that I'm excited to get into down the road is how you can structure your business so you take passive activities that you're doing and put those into a passively owned business to create passive income over there that you can eat up with your passive losses. Be sure to catch those videos in a future series that we do, and catch our final video here in our tax entity structuring series where we wrap it all up.